So good morning, everyone. Welcome to this Kepler Trust Intelligence event focused on growth opportunities. In a few moments, we will be hearing from our first speaker, Prashant Khemka, founder of White Oak Capital Management, which manages Ashoka India Equity. India has seen some far-reaching reforms in recent years, which have led it to rocket up the World Bank Ease of Doing Business Index. This, along with its highly educated workforce, good demographics, and the world's desire for an alternative business partner to China, means we think the country could be an exciting growth opportunity. Ashoka India Equity itself is the top performing India trust since it launched in July 2018, and so has just had its third 2.3% premium as of last night's close. Before we start, let me remind you, or introduce you if you haven't been to one of our events before, that the Q&A will be at the end. You should be able to see a box on the right of your screen. Please put your questions there for him at the end. Before I hand over to Prashant, him on his 50th birthday, and thank you very much for taking the time to do this on a special day. I'd say, Prashant, I would have said the time on this day, and I will hand.
Thank you, Thomas, and thank you everyone who's joined us today this morning in London. I also send you my best wishes of the festive season. As many of you might know, today is Diwali, which is celebrated worldwide by Hindus, and we are celebrating here at home as well, along with what happens to be coincidentally my birthday, 50th birthday as well. So no better way for me to celebrate the day than to share it with an audience who's got an interest in investing in India and interest in Ashoka. So let me kick off with a little bit about ourselves. On the next slide, you'll see that we are 4.5 years old. So next slide. We have back of very strong performance, raised $5.6 billion under management now, 131 people in the organization, most of them based in India, but also in Singapore. We have office in UK and Switzerland as well. Of the 5.6, close to 77% comes from outside India. Remaining is from within local market in India. Of the overall pie by client type, 40+% comes from sovereigns and other institutions. 40+% comes from private banks, wealth managers, ultra HNIs, and family offices, a lot of whom believe are present on the call today. And 15% comes from other places like university endowments and charitable trusts and so on. Next slide, a little bit about myself. Grew up in Bombay, India. Till about age of 13, I wanted to, my only thing I did was play cricket and wanted to be captain of Indian cricket team. But in 1985, fell in love with equity investing. When that year, the market went up 100% after Rajiv Gandhi became prime minister. Since then, I've been throughout for the last 36 years, invested in Indian equities, more or less 100% of my personal net worth, and find it to be the most exciting of all markets globally. Though over this time, I went to the US for further studies, lived there for 11 years, joined Goldman Sachs, worked for 8 years, most of which was at Goldman Sachs Asset Management, where I rose to become senior portfolio manager and co-chair of investment committee before moving to India in 2006 to start and lead the asset management business there, which I did till I left in 2017. Along the way, was also made the head and lead PM for global emerging markets. And both of the strategies, proud to say, had top-notch performance. The GEM strategy as well as India strategy. India strategy was probably among the top ranking India funds, as a result of which got several accolades over the years, including Citivire AAA rating, which on the back of outstanding performance by the team here at White Oak, I regained that AAA rating here at White Oak as well. So with that, let's more about performance later on, but now move to the investment opportunity that is India. Next slide, if we go to, we'll talk a lot about macro, but I want to emphasize, and this is a consistent view I've held for decades, that the most compelling reason to invest in India has always been, continues to be the alpha opportunity. In my experience, India is one of the few markets where I feel confident one can, if they do right, if done rightly, one can generate greater proportion of the annual return from alpha than the underlying market itself. That's been my personal experience and track record over the last 14 years plus, but also I'm sure there are others who've delivered alpha of very strong magnitude. What you see here, and there are various studies published on this subject, can Google up. This is a study published by Wall Street Journal just before COVID hit last year, which again highlights the same point that India has persistently delivered higher, at the average fund manager in India has persistently delivered higher alpha than his counterparts or her counterparts elsewhere in other markets. So this is, while we would not talk a lot more right now about this, but this is the most important. With that, let's move to what is generally considered more interesting, which is the macro case for India. We'll talk a few minutes about the long term and then the current macro environment. The long-term case for Indian equities can be distilled into these four important bullet points. In the order, I would say, of increasing or ascending importance, I would list them. The economic evolution, India since independence, which was about 70 plus 73, 74 years ago, for the next 3-4 decades, tried a few centralized planning models in the economy, which didn't work so well. But since 1991, I would say, it's going through a once-in-an-era transformation from a closed, centrally planned economy to a more free market economy, which has resulted in 6 to 7%, close to 7% growth over this time. More importantly, then, I want to highlight that it's been a domestically driven growth underpinned by strong demographics. India has experienced very solid consumption, domestic consumption, which makes up 58% of the GDP, unlike, say, China or other Asian countries, which are driven largely by exports and investments. Consumption, India's has been a consumption-driven and also investment, but largely consumption-driven story. Even more importantly, from an equity investor's perspective, India presents a very profitable and diverse listed corporate universe to pick and choose from. And we'll talk more about it, but this allows for one of the key reasons that allows for greater alpha potential. And most importantly, which is often not talked about, but in times like these, particularly after what's happened in China over the last few months, I think this has come as a good reminder to investors, the importance of democracy and the entrenched institutional framework that comes with a stable democracy. The independence of central bank, election commission, the judiciary, most importantly. In fact, I've often joked that the most important thing that the British left behind is not necessarily the language English, which is fine and nice, nor the railway system. But besides cricket, the most important thing is the rule of common law, which India enjoys and has largely preserved ever since. And that is very important, not only for the citizens of the country, but also for us all, as you all in the audience, as investors in the country. It's not so easy. I would say it is very difficult for the government or the authorities to confiscate property that contractually belong to others. That is not necessarily the case in many emerging markets where they have more authoritarian regimes where there is no hearing. In India, even a foreigner can sue the government in Indian courts and expect to win on merit. Let's talk about a little bit on each of these, starting with the strong domestically driven growth, underpinned, as I said, by demographics, which are very well accepted and are not really subject to debate or argument here because these are well established facts. India is, as you see in the top left side, the only major country which is experiencing an increase in the proportion of working age population. Most major economies like Europe, US have been in decline for quite some time, and even China has gone in a decline and will continue to be so over the next 30 years, whereas India is expected to grow on this metric for the next 20 odd years before flattening out and modestly declining. Not only is this factor important to highlight that this factor of working age population as a proportion is considered by economists to be an important factor contributing to overall GDP growth. What you see on the top right side is that this population is also becoming increasingly literate and educated. The number of graduates coming out of India every year is engineering graduates is highest in the world. And as a combination of these two facts, what you see on the lower left side is that middle class is expected to increase in India from currently 22% of the population to 79%, the biggest jump compared to any other country. So much so that of the total people that are expected to be added to middle class over the next decade, the majority is expected to come from India. Next slide. If we talk about the corporate universe, entrepreneurially driven, if you see the right hand side graph first, what the bars show is the proportion of a country's market cap index that is owned by government. So state-owned enterprises. India is one of the lowest at 6%. That compares to global EM average of close to 20%. And China, which is the red bar there, pale red, is higher than that. Also, what shows on the left-hand side, while there are a lot of numbers, I don't expect you to read, and not each one of them is important, but some of the key ones are highlighted. India is one of the most diverse universe of opportunities captured by Herfindahl index, which you see in the bottom row, is the lowest for India, which shows the degree of, or captures the degree of concentration of the investable universe. At 222, India is the smallest, which means the most diverse universe, whereas on the other extreme, you have Korea, Taiwan, Russia, which are 1,000 or close to 1,000 or more. So entrepreneurially driven, diverse corporate universe makes for very fertile ground for stock pickers to generate alpha, in our view. We go to next slide now. The most important element, which often is not talked about and overlooked, is the institutional infrastructure of a mature democracy. Think of this as corporate governance of a company that you might be evaluating to invest in. You would not invest in a company simply because top line is growing, which is, or expected to grow, which is equivalent to the growth of the economy. You would also not merely look at growth of profits, which can also be very misleading. While important, it can be very misleading. You have to, in any company that you invest, as we do, in fact, the starting point for our team is analysis of corporate governance, because that's very crucial. If corporate governance is not adequate, then the profits and cash flows won't be shared with minority shareholders in their fair proportion. And so when you think of countries, similarly, governance is very, very crucial. And here, what you see on the left-hand side is minority investor protection rank for India versus other emerging markets. It ranks very highly compared to China and other countries. And the right side is the net democracy score. We firmly believe that there is a relationship where you have more stable democracies, there the scores minority protection is better, not a strong correlation, I would say one for one correlation, but certainly there is a cause and effect there. So India, as you can see, at +9 is very strong net democracy score as per the polity database of the US, which is widely followed, compared to other economies. If we go to next slide, then you also see the stability and predictability of central bank. Central bank is another important institution in a democracy. What the orange line shows is the predictability as per Baker, Bloom, and Davis, who are Harvard professors who published this chart for long. India's policy has been a lot more predictable than not only the EM average, but also the global average. A lot more certain in terms of central bank's predictability. Next slide, please. So what I talked about the governance, this captures in P multiple. You'll notice that over time, there has been a discount applied by the market, and rightly so, on authoritarian and least democratic countries, which is the left side, top left side chart. And also on the top right hand side, there has been a discount applied to government owned companies than the privately owned companies, and both rightly so. And these are not to be viewed as countries which are attractively valued because they're trading at a lower multiple, but one should view them as countries that could be value traps, that are trading at lower multiples because of poor governance. Same is true at the company level and is true at the country level. We go to the next slide, please. India also ranks very highly on ESG disclosures, and partly the other aspects of the institutional infrastructure that I talked about, democratic infrastructure that has a role to play here. India, obviously, Europe leads, but India is very close to Europe on this count, ahead of even US and certainly China. Let's now move to the near. So far what we talked about is the longer term structural aspects of the Indian equity market and the economy. Now let's talk about the recent reforms and policy initiatives over the last few years in the next 2-3 minutes. Starting with the next slide, the Modi government has been in place since 2014 and has steadily but surely undertaken several long pending and very difficult reforms like the GST, like introduction and passage of modern bankruptcy law and real estate regulation, and removal of several forms of subsidies on energy and fertilizers, rationalizing those subsidies. So in the initial years, some of these very difficult decisions were taken and implemented. The government has also then undertaken several growth enabling reforms like labor reforms and agricultural reforms and outright privatization, which I'm most particularly enthused about. And finally, the government has also more recently undertaken growth enhancing initiatives like tax rate was cut quite substantially towards the end of 2019 from peak rate of closer to 35% to now closer to 25%, and also introduced production linked initiatives, incentives for the manufacturing sector. It's been a big boost. So a little bit more on that on the next slide, please. As a result of these initiatives, as Thomas also mentioned, India's ease of doing business ranking has substantially improved, and nobody has blamed India so far for tinkering or trying to influence the World Bank on this ranking, but India has improved from 142 to 63, with several subcategories showing very big improvements. Next slide, please. So this is what I'm most excited about. Air India, which for long has been a thorn, if you will, for governments and the budget, consuming a lot of tax revenues, and governments have struggled to privatize. This government has finally, just last month, concluded, well, taken a big step forward by auctioning to Tata Group the national flag carrier. We have somewhat mischievously put it as India's. I'm a big fan of Margaret Thatcher. I'm a big fan of privatization. I believe government has no business to be in business. I would love to see this government pick up further momentum, and I hope Air India's privatization is first of many more uh, larger ones to come. Very promising and something to be keenly watched. Next slide, please. Production linked initiatives has been a big boost to manufacturing. This is a time bound program, and incentives are linked to actual production, so much more likely to be effective. And we've already seen large global players set up shop in India, such as Samsung, Foxconn, and Panasonic, and Hitachi, and Flextronics, and so on and so forth. And many Indian companies, large number of Indian companies, not mentioned here because the audience may not be able to relate with them, are doing extremely well, and we have some of those in our portfolio as well. Next slide, please. So coming to corporate earnings now, recent years and recent quarters have seen a very strong rebound post-COVID, particularly. In fact, last year, which was early in the year ending March, was expected to be down double digits. India ended up delivering mid-teens growth after nearly a decade. And this year, the growth is expected to be around 30% for corporate earnings. So a strong rebound after a long time. This, if delivered this year, as per consensus, it will be the strongest corporate earning growth in the last 17 years. Again, compared to the region and rest of EM, this is India's earnings growth has been most stable through the pandemic and one of the fastest growth. What has aided this earnings growth, next slide please, is several factors. I'm only going to talk about a couple of them. A market share consolidation amongst the larger listed players due to supply chain disruption. Some of that market share might be taken back by the mom and pops and unorganized sector when they get their supply chains in order. But a lot of this market share gain is likely to be permanent and structural, because once gained, these companies are going to hold on to them successfully. And then globally also, partly because of supply chain disruptions due to COVID, but more so a trend that has been going on for several years that has only accelerated because of pandemic, is the China plus one diversification strategy of global players who want to diversify their sourcing from China. And we are hearing that very consistently from Indian companies who are setting up new capacities, who are getting raising money to set up new capacities, who are getting a huge number of orders from Europe and US, from customers who were otherwise solely dependent on China but now want to diversify. Next slide gives you one example of China plus one. Can we go to the China plus one for a minute? Yeah. So here you see in the top left-hand side graph how the imports from China, which is the top red line, into the US has seen a declining trend over the last 3 years, whereas imports from India has seen an uptick. Most recently, a sharp uptick. The lower left-hand side shows the chart for growth in chemicals industry, India leading the world with mid-teens, low to mid-teens growth, certainly a sector where Ashoka has benefited a lot in its investments. Next slide, please. So there are certainly risks to the investment case as well. If there's a sharp reversal in global markets, India would not be immune. There are still some unknown potential risks of unknown developments on the COVID front. Sharp spike in oil prices, less of a concern. I mean, the oil prices have nearly doubled this year and not really caused much of a problem for the Indian economy. But if it were to say go up another 50 to 100% from here, certainly it could create a hiccup. Next slide, please. Now coming to the most interesting part of my discussion today is talking about our Ashoka India investment trust. Key points I would like to highlight is a zero management fee fund. The team only makes any money if we generate outperformance. And the performance fee is not a function of absolute return, but a function of the outperformance over the benchmark. And performance fees are paid in shares of the trust. And there is also an annual redemption facility at NAV. Next slide, please. Next slide, please. Performance has been very strong for Ashoka since inception. You'll see on the left-hand side at the bottom row, 92% net return compared to 41 of the benchmark for 51% outperformance. Annualized, that translates to 22% return compared to 11 for over 11% outperformance. Again, highlighting the point I was making earlier, India is a market where you can add or create more wealth through outperformance than from the market itself. Each of the years, 2019, 20, 21, 3 years, we've outperformed very robustly, as you can see on the individual lines above. On the right-hand side is the line graph, and the green bars and the red bars are quarterly outperformance and underperformance. As you'll see, there's been no single quarter of more than 200 basis points of underperformance, whereas there have been large number of quarters with more than 200 basis points of outperformance, including a quarter with more than 800 basis points of outperformance. That was the quarter when COVID hit and we didn't have much cash. We are almost 100% invested. So it's not that we benefited from cash. It's all stock selection as seen from the next slide, which is up and down capture. Out of the last 14 quarters, 9 out of 14 we've outperformed at an average of 213 basis points. And the team has delivered very strong alpha in both up and down markets. 5 down quarters, the team has outperformed 3 out of those at an average of 272 basis points. And in up markets also 6 out of 9 outperformed at an average of 180 basis points net outperformance. So very rarely do you find managers who can deliver strong alpha in each market environment, up market and down market. Next slide, please. What you see here is the source of alpha is all stock selection. If you just look, this is market cap attribution. Bottom row, if you see, this is gross of fees and tax. So 128% return compared to 43 in the bottom row, for an outperformance of 85%, of which 106% has come from stock selection, and allocation effect, if anything, has been minus 21%. So very strong, outstanding stock selection effect in each market cap segment, as you can see from the green box that is highlighted. Similarly, when you see the next slide from a sector attribution perspective, very strong alpha. Bottom row, you'll see that 100% of the alpha or more has come from stock selection, and every single sector has positive stock selection alpha, very well distributed. Next slide, please. This shows the top 10 contributors and detractors. What is highlight here is that they're very well distributed. It's not that 1 or 2 or 3 or a handful of stocks have made or can make or break our performance. It's very well distributed, with the 10th largest contributor being larger than the top detractor. Next slide, please. Now, as in cricket, you can score any amount of runs, but what matters is whether you score more than your competition, the opposing team, for you to win. So what this shows is our performance relative to the listed peer group, which is convenient because there are only 3 other competitors, India dedicated. Top half is about NAV. So green, whatever is in green has outperformed the benchmark. We've taken MSCI all cap here as the benchmark, and the darker the shade of the green, the higher the performance. So you'll see each and every time period, we have been the best performing of the fund, whereas for most part, the peer group has substantially trailed the benchmark. The peer group average, in fact, on each of these time frames, the peer group average has trailed the benchmark. And the right 2 columns, if you see, shows the huge outperformance that Ashoka India Equity has delivered relative to both the benchmark and even more so, even bigger outperformance compared to the peer group. So on a cumulative basis, since July 31st, when we became invested, we've delivered 92% return compared to 20% return of the peer group average, which has trailed substantially, which to the benchmark, which is 41%. The results are pretty much the same when viewed on a share price basis. Very strong outperformance, as you can see, over all times, um, um, because the discounts that these peers have traded have largely remained there to the similar magnitude. And we have tended to trade at par or a small premium, as is evident in a slide or two that you'll see. Next slide, please. So this is the share price versus NAV. The top line is Ashoka, and the others are for peer group. As you'll see at the bottom of the slide, we have traded at a small average premium. I think reflecting the strong trust and confidence that you all investors in Ashoka have had in the trust, compared to peer group, which have tended to trade at double-digit discount. Next slide, please. Also, when we started, we were relatively small, but with your confidence in us and endorsement, we have grown quadrupled in terms of market cap. As you can see on the left-hand side bottom, from 46 million market cap, we've gone to 187 million. We are now no longer the smallest, and we are at the pace at which we are growing. Hopefully, with your support, we should get to the high end or the largest of the peer group here. Average daily traded volume has also increased over the years. Next slide, please. This is a portfolio composition as of end of last month, very well distributed across sectors, energy and utilities, because of the limited number of companies and lack of companies that match our investment philosophy. We don't invest there, but otherwise very well distributed. In terms of market cap, bottom left-hand side, you'll see again very well distributed, all cap nature of the portfolio, roughly speaking 40, 30, 30 or thereabouts in large, mid and small. Key characteristics, you'll see we tend to have companies with higher returns on capital and higher projected growth rates. Next slide, please. We have a very strong independent board. Many of you know possibly the board of directors here: Andrew Watkins, Jamie Skinner, Jerome Booth, Rita Dhoot, come with very long years of experience in the profession, as well as in directorship role at other places. Next slide, please. So in summary, the Indian equity market, we believe, is the best for active investing. It's a domestically driven economy with a large pool of profitable corporates available in the backdrop of sound governance and a stable democracy. Reforms and policy initiatives of recent years are supportive of growth, and we at Ashoka India Equity Trust, we believe, provide a compelling proposition with an outstanding track record of the team and a uniquely aligned structure. It's aligned with investors. With that, I'll pause and look forward to questions.
Thanks very much for the presentation. If you're in the audience, please do send your questions through. We've already had a few, but we should be able to get through all of them. Before we get going with the questions from the audience, Prashant, I was keen to ask you why you think the alpha generation has been so consistent across the sectors, because I think that perhaps speaks to how you structured the analyst team and the compensation.
Absolutely. For that, I'll request Akshay to go to slide number 37, please. So I've always believed, and this slide hasn't changed for years, if not decades, that to generate consistent performance over time, it has to come from stock selection. And it can only happen if you have focused, strong investment culture. While it sounds abstract, I understand, but this is what the truth and reality is. We call it performance first culture, meaning that the sole driver for everyone on the team is that we must generate the highest return for our clients compared to anyone else in the peer group. So for us, we have the zeal or drive of a sports team, where not the right time to be talking about the Indian cricket team with how they're performing at the ICC World Cup. But if you're going to a World Cup, you have to go with the aim of winning the World Cup and not just qualifying for the semifinals or whatnot. So that's the drive all the time on the team, that we must deliver the highest return, not a top quartile or top decile. And this culture is founded on these four pillars of philosophy, team, process, and portfolio construction, which are aligned with one another, meaning that it's a stock selection based philosophy. To go with it, we have the best team of stock pickers, investing using a time tested, disciplined, fundamental research process, at the core of which is our proprietary OPCO FinCo framework. And all along, we maintain a balanced portfolio construction approach, which consciously avoids market timing or top down macro considerations and ensures that performance comes from stock selection. In the interest of time, I'm not going to go over each of these, but I just want to highlight our investment team on the next slide. At 20 people, it's the largest team in the peer group. I would say it's larger I think a client mentioned to me that it's larger than the teams of all of the peer group put together, at least in the trust market. So we have not cut corners. We have devoted from day one depth and breadth of resources. We have several people here who come with multiple cycles of experience. There is extensive global investing experience beyond India investing experience on the team. And we have, given the luxury of resources, a unique team within team structure where each sector, each industry, each stock is covered by at least a team of 3 people, if not more, the team. Each of these are either unique or uniquely strong on our team. And a performance of any sports team, and investing is no different than sport, I strongly believe. Just like performance of any sport team is a function of how strong the team is, so is the case for investment. And we have built this. That's been my personally the best accomplishment, building the strongest team in the industry.
Thank you. We've had a question around the IPO market. So clearly, it's been quite a busy period in India, particularly the second half of the year. What are your views on what's driving that? And are you able to capitalize on pre-IPO opportunities, private investments?
Absolutely. See, IPOs are legitimate opportunities. I've had people, in fact, one of the peer group had once mock us that we are participating in IPOs. To me, IPOs are legitimate, legal, ethical, morally correct opportunities to make money. Clients give us money, their capital, hard-earned capital, to generate returns, right? And I believe IPOs represent a very exciting opportunity. It's a fertile ground because it's an inefficient time in the life of a company. It's the discovery process. Given our investment approach, where we do all the fundamental research, financial modeling, and all that, we don't need to depend on sell side models or sell side research reports. We don't look at the stock trading chart to help us decide on investing. Investment teams who are dependent on sell side, who are dependent on trading history and so on in their investment style, may struggle to get comfortable with the IPOs, right? But those like us who do fundamental research, primary research, and take an independent viewpoint, original decision, for them, this is a fantastic opportunity, and it behooves us to capitalize on this opportunity. And we have capitalized it better than anyone in the peer group. We have participated in IPOs as anchor investor, given a reputation of the team on the back of its strong performance and unprecedented, scale up. We do get anchor investment opportunity all the time. Companies like our name to be in the anchor list, and Ashoka Equity Investment Trust, as we speak, is an anchor on some of the IPOs that are underway and has been anchored in other IPOs in the years past. We also get the opportunity to be pre-IPO investors, and we have taken board approval, and a certain portion of 15% at cost of the fund can be invested in pre-IPOs, and we today have pre-IPO investments. Again, same reason companies love to have us as pre-IPO, because they view it as in a way, an anchor validation, that when they come to the IPO in the next few months, the IPO would be well received, given that Ashoka has, I don't want to call it stamp of approval, but certainly the team has very strong reputation. And having Ashoka as an early investor, pre-IPO or anchor stage, is considered as a positive. And in my view, I don't think there is any other, be it in London trust market or generally more broadly, others have capitalized on the opportunity as well as Ashoka has.
And that sort of raises the question of the impact of the broader pool of assets you manage in terms of your significance in the market. And we've had a question about, how similar is the Ashoka portfolio to the rest of the 5.6 billion that you're managing? Is it all run to the same model, or do you have very different mandates?
Very, very similarly run. Obviously, Ashoka, there are regulatory differences. For example, we cannot do pre-IPO in 90% of our assets or more. Just regulatorily not allowed in daily liquid funds. Regulatory or by mandate, sovereign wealth funds don't allow in unlisted securities. So barring those mandate requirements, they are run very much similarly. Also, in Ashoka, it being a closed-ended fund, we can invest somewhat more in the smallest of the market caps and the least liquid of the market. The portfolio is extremely liquid, right? Well, liquidity, again, lies in the eyes of the investor, but according to us, the portfolio remains very suitably liquid. But I'm just saying, compared to other fund vehicles which are daily liquidity product like a UCITS fund, they would have a higher liquidity threshold than a closed-ended fund, rightly so, as in case of Ashoka. But as you saw, 40% of the fund is in large caps, which is today more than $5 billion or so, maybe $6 billion at this time. About 30% is in mid caps, which is 1.5 or 1.75 to $5 billion, and the rest is small cap, less than 1.75. So barring regulatory restrictions and liquidity driven considerations, the portfolios are largely the same. And performance across board, our UCITS fund is the best performing UCITS fund over the last 3 years by a huge margin, on the back of which we've got the AAA rating. And like the difference between first and second is quite sizable over there as well.
In the interests of trying to cover everything, I'm going to see if I can tie a few questions together here. So we've had questions about the high inflation rate in India, which is quite persistently higher than other countries, but also particularly high at the moment. Question about the currency and whether Indian market is vulnerable to general emerging market currency shocks. And then a question around valuation of the stock market and, of course, your portfolio, which I know is a very broad question, but perhaps they were all factors of the current macroeconomic environment. Which you could give us a view on where things stand.
Yeah, unfortunately, I don't think we have the macro slide in the deck today. We didn't include, so I'll just speak to it. So Indian currency has been one of the strongest compared to emerging markets or even compared to developed markets against the dollar. So over the last 5 to 7 years, I believe the currency has depreciated, but on average by 2 to 3% a year. I believe many of the developed market currencies have depreciated more against the dollar. Let alone the emerging market currencies, several of them have depreciated by a lot more. So it's not necessarily the strongest of the currencies, but it is one of the stronger currencies. That is one. Second, but over time, let's be sure, over time we assume, and you should expect, consistent with the last 25 years history since liberalization, you should assume a 3 to 4% depreciation of the rupee against the dollar, which is in line with the inflation differential. So inflation in India, you should assume 4 to 5% as base case inflation. That's been the case over the last 20 plus years and reasonable to project going forward as well. But we've never, again, a slide that we removed, India is an emerging market that's never had hyperinflation. In India, double-digit inflation, when it approaches, that's considered hyperinflation. The reason we haven't had inflation is because elections in India are won and lost on inflation, oftentimes. So the governments are very clued on and focused on inflation, right? So as Sir Winston Churchill once said, democracy is the worst form of government, but for all the others. So here you see, for in controlling inflation, the Indian democracy has played a very strong controlling role. So that is on inflation, I would say reasonable to assume 4 to 5%, and look up the long history, and that is where it has been. Because of that, a 3% odd currency devaluation over time. Some years 5 to 10%, some years 0%. Like today, year to date, it's 2.5%. So that is how I would think about currency. India has never had a coup, political coup or something. So, when you think of emerging market, you think of Latin America, hyperinflation, political coups and all that. At least in the last 73 years, all the transitions, when a government loses power, we haven't even had a situation like what US had with Trump, where he would refuse to leave the parliament, the White House, or the Congress, right? We've never had such a situation. No matter who's in power, when the ballot is casted and votes are counted, they have very gracefully ceded to the winner. And that's the history over the last 74 years. And as of now, it doesn't seem like there is reason or basis to expect anything different.
Fantastic. So maybe one final question. We will have to move on to our next.
That's also, by the way, something that the democratic system, something also part of the rule of law that I would say that the British have left behind and has continued to function very well.
So perhaps picking up on that point, and I admit I don't understand. I'm not aware of the situation with Cairn Energy, but we had a question about that situation. Does this raise the spectre of retrospective taxation? Is that something you're worried about?
Sorry, clean energy. You talked about clean energy?
Cairn Energy.
Cairn Energy.
Yeah.
Certainly. So certainly, see, that's a perfect example of how the judicial system has worked extremely well against or in favor of a aggrieved party, which is a foreign entity which is fighting against the Indian government. So there's a difference of opinion, difference of viewpoint on a point of law. And Cairn isn't alone. Vodafone did the same as well, right? Vodafone was fighting even a bigger case in terms of dollar amounts. And the courts, Indian courts as well as foreign courts, have ruled in favor of the foreign party against the Indian government. The foreign parties have prevailed. And Indian government has finally accepted that the foreign parties have prevailed. In case of Vodafone, Vodafone has continued to do business in India without the risk of retribution in any kind of vindictiveness on part of the government. Very few countries, when you think of emerging markets and think of the largest emerging markets, how many countries can you think of where a foreign company can continue to do business in the country while suing the government of the day in courts globally?
Fantastic. Thanks very much, Prashant. It's a very interesting presentation, and we do appreciate you taking time out on your birthday to do this. I hope the rest of the day is equally as enjoyable, maybe even more enjoyable.
My pleasure. Thank you for making the day so special. All of you, thank you in the audience for joining today and for your questions. Thank you, Thomas. Thank you, Kepler.
Thank you. And to you in the audience, please do stay on for our next speaker, which will be Praveen Kumar, Bailey Gifford Shin Nippon. And thanks once again for your attendance. Goodbye.